Chalkboard tutorials, formulas made simple. So hey guys, welcome back to Chalkboard tutorials. This week we're going to be continuing with our formulas made simple series, where we introduce some of the frequent questions, formulas or concepts that we might come across or encounter in our day-to-day lives. Now, we won't be going into too much depth and analysis just yet. I would be putting out future videos and case studies that have a bit more of a comprehensive breakdown. But for now, the idea is to have a very minimalist introduction to some of these concepts that can then be used as a base to progress onto more intermediate and advanced work should you wish to do so. So let's dive straight into it. Today's episode is going to be focused on inflation and its relationship with other variables such as interest rates and a general broad macroeconomic view as to what happens when inflation sets in. Now, this example is pretty theoretical and it assumes a very linear relationship, which is not how the world works. But I think it sets out a good example as to the ripple effect it would have from a macroeconomic point of view. I previously made a video on inflation that provides you with a basic introduction to the concept and why it occurs, so do check it out. But for the purposes of this episode, we're going to presume that inflation is on a rise. So let me just grab my stylus. So inflation is on a rise. What do you think happens to the interest rate when inflation is on a rise? Now, if you'd viewed the previous video on inflation, you'd have come across the equation for exchanges and the general equilibrium it has to maintain. For the purposes of this episode, I'm going to use the US as an example. So when inflation sets in, presumably the Federal Reserve decides to push up the interest rate. So the interest rates rise. And it functions as kind of a combat or an offset for the rising inflation. So the Federal Reserve comes in and they increase interest rates. Now, when the interest rates are increased from what they used to be before, what do you think happens on the investment sphere? Well, one theory is it would attract more foreign investors because of the higher returns or because of the high interest rates. So again, there will be more activity within foreign investors to invest in the United States. So foreign investors would go up. Now, with more foreign investors being interested in investing in the US, what do you think is going to happen to the US dollars? Well, there's a bit of a caveat here. Should one want to invest in the US, they would have to convert their base currency to US dollars. So I don't know, presumably if you're a British investor who deals in GBP or pound sterling, you'd have to convert it to US dollars before you could have it invested in the markets. Now, what that would do is the US dollar would strengthen and the bid would go up. So the value of the US dollar in comparison to the other currencies would essentially hike up. What do you think that does to the trade deficits? Well, simply put, when you see the dollar being more valuable, it would increase the price of exports. So whatever US exports outside would be a lot more expensive. And it would also mean foreign imports become a lot cheaper. This would presumably lead to less exports and more imports for the US. So the US companies would export less and would import more. Put in an example, so they would export less and import more. What this would do to the trade deficits is it would further increase the trade deficits. So that would go up. Now, given this scenario, what kind of stocks do you think would do great? Well, the stocks that would probably not perform just as good would be export sector stocks, such as, I don't know, for US it'd probably be agriculture or steel. Agriculture or steel, and they would probably see lower profits. Any kind of companies that function within the import sector, so I don't know, take BMW or Volkswagen, they'd probably see a slightly higher amount of profits. Now again, this is a very linear example, but it kind of gives you an idea as to inflation and its ripple effects from a macroeconomic point of view to the country as a whole.